The US markets are now rallying. They're now up 17% since they bottomed out a few weeks ago. But could this be a very silly play from a lot of new retail investors? The US markets are definitely overvalued and earnings are not catching up. But in this video, I'll explain to you why, despite this, I do actually think that this recent rally is going to continue. So let's start this off by looking at the Shiller's PE ratio. Right now we're looking to see as if we're having similar results, a similar pattern to 2022 when we saw the correction back then, and we are now seeing the very same thing here. We are currently yielding results of 34, indicating that the US markets do actually look overvalued, and I do think this is going to set the general theme for this video, but I'll get on to why I think it's not really so much of an issue as we go on throughout the video. So I do actually have an Excel spreadsheet here which goes over near enough every single metric within the US macroeconomic sphere. It goes over labour markets, consumer price, housing markets, you name it, this sheet goes over it, and from this I can conclude a basic score on the health of the US economy, and right now it's not actually looking particularly good. As you can see here, the nominal total, in which is a ideal, which is a perfect situation in reality, is 150 on this sheet, and the current result yields 59, which is basically three times below where we currently need to be, indicating that the US economy is not in a good position. So I do think it's fair that the Fed currently has interest rates set at quite a high value of 4.3, which obviously yields a score of 1. And on a 10-year Treasury rate, we're seeing this still around the 4.26, so 4.3 again. Again, it's just not ideally something you want to see, as it does indicate that the economy is overheating and potential signs of a recession are looming over the US markets at the moment, especially when the IMF said a couple of weeks ago that there's I think it was either a 40 or 60% chance of a recession, which I think was 40, which is really not something in which you want a body like the IMF to come out and say, because that really does put doubt over the US markets. But despite all of this, we are actually watching the economy bounce back at the moment, in particular the S&P here. We did obviously see a massive downfall around the late February time, early March, which is actually something in which I did predict. I didn't predict it to quite go the way it did with the catalyst being tariffs, but it was something in which I knew needed to happen for sustainability. I mean, since the election cycle, we saw a very unnatural amount of growth within the American economy, and it just needed a reality check, and tariffs, which is a weird way of being a reality check, were the reality check. So it's something in which did need to happen, and I'm glad it happened. But now we are waiting to see if earnings can really match up, to see if this recent hike is validated, basically. And as far as earnings are concerned, we are expecting to see a 6.1% increase from the similar period last year, a 3.7% higher revenue, which could follow a 13.8% growth in earnings on a 5.4% revenue growth in the preceding period. So we are expecting this to be relatively good, but I don't actually think that's good enough still for the US markets as a whole. I think this Shiller's PE ratio is only going to get wider and wider apart. So it's just going to be something in which is going to be a very pivotal, I keep saying these words lately, but a very pivotal point to really watch on these Q1 earnings, as it will set the scene for the rest of the year, essentially. And it does actually say on here that Q1 earnings estimates have steadily come down since the quarter got underway, with the current being 6.1, of course, but beforehand the expected growth was 10.4. So it does show that there is a lot of doubt within this Q1, as results aren't actually as good as we would have liked to see them, and the outlooks are being slashed as well, especially from companies like Tesla, as they're going to see a lot of implications from tariffs, which they can't help. But again, despite this, we are still seeing the markets rally, so it could show that this is not a sustainable period to be going long term for the US markets. In my head, we should really see this drop off quite significantly, but I don't think that will happen. I think one thing that's really important to note with current investing and just younger generations in general is, and I come from a younger generation, people don't tend to actually understand any of this anymore, especially a lot of the people that are investing nowadays, they download a trading app on their phone and they just buy in when they see it go low. They don't really know what is going on. They don't see the news come out. They just see the volatility on the chart. They don't know why it's happening, but they buy more at low end and then they sell at the high end. They don't really know what's going on. And I know this from a first hand point of view because I know people that do this. It's not the way to trade at all. You really do need to know what you're investing in and why the moves are happening. So if you don't know, then please do hit a like and subscribe because I do try and explain it in a relatively great detail. But I think the markets have recently transitioned from actual investing into almost a competition in the way that we're just taking liquidity from each other. It's not sustainable and it's not something in which is good, but I do think that's the way that investing is going at the moment, just because people aren't that educated that are able to access the markets these days. And that is kind of why I don't think we're going to see a huge sell-off, despite the Shiller's PE indicating that we are overvalued. I think mostly what people are trading off right now is tariff news, which of course is massive news. It is something in which affects the macroeconomics. It affects CPI, which we're going to get data for within the next coming days. It just affects a lot of aspects to do with the US market. And people are trading off that instead of actual business data and outlooks and estimates. So it's something in which we do need to keep a keen eye on, because it's something that intrinsically will change the market, but people aren't really clued up to why tariffs are going to affect certain companies. They just know it will. And I do think there's money to be made in that, because you can work your way around this. Of course, when you see tariffs affecting companies like Google, why on earth would Google see implications from tariffs when they are a primarily a web browser which earns most of its revenue through advertising? Why would that really affect them? Of course, there's a knock-on effect where advertisers are going to be able to spend less because their capital is going to be affected, but it shouldn't affect it that much. But people are selling off the big stocks because they don't really know the implications of the tariffs that have been announced. But there is good news around the US markets, of course. Even though the Fed hasn't actually cut rates now for quite some time, they are basically saying that they might be cutting these rates going forward into late summer, which will be definitely something to look out for within the US markets, as it will definitely hike up prices in the markets, of course. But it's something in which is very dependent on a lot of factors in which are still yet to play out, such as Chinese and US relations. If that can get sorted out, then it might even happen sooner. I know there's talk surrounding that in the coming days. It depends when you're seeing this video, of course, but there's a lot on the plate at the moment for the Fed, and I do think they are doing a very good job with what they currently have to handle. So what are these smart investors doing now, and what can you learn from them? Well, if you're too tech heavy, I think it's time to rebalance, because tech is something in which is getting affected by these tariffs quite harshly. But I do also think that tech could see quite the bounce back in the coming weeks, depending on the Chinese tariffs. But it's always good to diversify your portfolio, maybe go into a bit of energy, go into some commodities, stay away from Forex, but just diversify. Secondly, focus on quality earnings, earning growth and strong balance sheets. If you're seeing companies that are starting to decline, stay away from them, even if their outlook is starting to look good. If their earnings are just poor, do stay away. Dollar cost average into positions, because of course that's the best way to stay away from very high downsides, because if you're putting all your money in at once and it goes down, you lose it all at once. At least then you can start to dollar cost average into that position and gain some momentum back. And finally, keep up to date with macroeconomic news. If you want to subscribe to this channel, I do a macro video at least 1 to 2 weeks. So I do try and keep my viewers informed, if I have any viewers, on what is actually happening within the US market. So with that being said, I'm going to end this video here because I don't want this to go on for too long, but this has just been my opinion on the US markets. In conclusion, the markets look overvalued by historical standards for sure. It definitely looks to be something in which is just going to continue to show pressure on a decline, but I think it's not too disconnected from reality. It's just priced for perfection at the moment, and I do think, especially with the current market investors, retail investors, not really knowing what they're doing as much as they have done historically, then I do think we might actually see a rally continue. But of course, it's really hard to say. Anything can happen in the state of the US market at the moment, as it is just extremely volatile. So do keep up to date on exactly what is happening. With that being said, I will see you for the next video.